Hello, Warriors. New week, new month. In July, let's fly. So I want to start off with Euro. And, I stepped aside on it into the elections because of election risk and uh, the market, all the fears were not realized. So what we had here in the Euro was a gap up, as you can see from Friday's close. And then when we opened for trading, we left this gap here. Also opened above this little neckline, this formation, which projects higher, probably up towards 108. But I want to talk about this as more than a trade, but more like trading psychology. Okay. And one of the most difficult things for traders is once they've closed out a position, is recommitting to the same position at price in a situation of being long, of having to pay up, or if you're short and you're recommitting still bearish and the market opens lower, is selling it at a level that's lower than your original position. And a lot of people, and myself included, will say, you know what, I don't want to have to pay up. For example, in Euro, I got out at 1718. I don't want to pay 107.35. I'm going to wait and see if I could get it back at my level or even better. And I'm going to tell you right now that the market doesn't care about where you liquidate your positions. The market doesn't care to accommodate you because you did. And you have to be tactical. If I was tactical about getting out, I also have to be tactical about getting back in if I have a reason. And last night, a reason showed in. So whether this trade works or not, it's about doing the right thing when you have another signal or a piece of evidence that's telling you something is happening. Whether or not it's negated in a few days or even the same day doesn't matter. But the right thing to do was to go with the gap and buy the market, even though I had to pay up 20 pips or so from where I got out on Friday. And if you believe in the position and you think there's a chance that the dollar is peaking up here, what's 20 pips compared to being left behind if this gap holds and we start to continue to squeeze the shorts down the road? So you can't have fear of paying up. At least now I have a new reason. I would question the euro now. For sure, you don't want to be long under these lows now. When you're buying it here, you have to risk under these lows. After this, if you want to be liberal with your stop, you risk these lows. If you want to be more conservative with your stops, say if the gap gets negated or the close from Friday is taken out, you get out of the way. But at least you're there if we have a continuation in the move and the dollar starts turning south and we crack the 108 level, which is next. So you have this neckline to trade. You could even have stops under the neckline. So right now, you could have pretty tight stops, even if you bought it right here under 107, call it 20. So, 36 pip stop, just in case this gap holds. And sometimes gaps aren't filled for a long time. I know a lot of people are going to be trading this for a gap fill, and they might be right. And maybe some people stayed long the euro into the elections and they made a good guess because it did open their way. But if you're going to be a tactical trader, you have to go with what the market is telling you now, not where you got out and where you would like to re-enter, but what is the market saying right now? The market's saying there was a gap higher opening after the election. That could all change next week, but I can't wait till next week because what if we have a great week in the euro and it starts cracking 108 and there's some, there's resistance all the way up, but I would say that this was the first level, this little wedge here. And you could see on the daily, today's highs up around 80 are right around both the 50 and 200 day moving average. So we had this line here, and then we're going to have another resistance line coming in up around this 109, 108.90 level. And there's even a bigger downtrend line off the weekly, which would come in here. So the point being, do what the market is telling you. Do not judge your next trade by your price that you got out of ever. Trade what the market is telling you to do right now. It was a gap higher opening. I have a bearish bias, even though Dixie could still, try and rally one more time back up towards this 105.30 level or so. We could still make another charge. We have a lot of data this week, even though the U.S. is closed on Thursday, capped off by the NFP on Friday. But I wanted to talk about psychology. And you need to get rid of that psychology that when you get out of a trade, you always have to get back in at a better price you got out. Write that down. You don't have to get back into the market at a better price than you liquidated at previously. Pretend you're flat, and what would you do right now? The feature was the gap higher opening in euro. You're not getting gap higher openings in anything else. You didn't get it in cable, right? You didn't get it in Aussie. Aussie's barely higher. Canada's trying to pop. Canada I took home. Um, we could still rally back to 138, just like the Dixie could try last week's highs again and go to 630. But you're wrong over 650 close only. So, I also reestablished short positions in the dollar. And if we rally above last week's highs, I may give it a shot into the NFP as an add-on. All right. So that's the currencies. That's your lesson for the day, that if you really take it to heart and you write it down, you won't be caught flat-footed after you're out of a trade and then the trade starts to run and you let it run without you because you can't get in at a better level you got out of. That's a key lesson. And, it takes people a long time to learn that. So I want to move to the gold. And, it's been steady, it's been holding up for quite some time. It can't seem to really take out support at this 2280 level or so. I believe before it's a good buy, it's going to clean out weak longs here and here and here. I'm not sure about the stopping point. I've been ballparking 2240, but I am willing to wait until some of the weaker longs are taken out under 2280. A measured move would take you, down towards 22, maybe even 2120, which is the old breakout. I don't think it's going to be that deep. Um, Something else that could be supporting a weaker dollar and have silver begin to outperform is the gold silver ratio looks like a flag to me. So this was just a recovery from a confirmed low. Confirmed lows imply that it's usually not the low. It's probable we'll make another low, which means that silver will hold up better. So if we get this break under 2280 in gold, I'm not expecting silver to be as weak. I'm thinking maybe $28, max 27 for entries on longs, and we'll see how much lower we could get. I'm still trying to be patient in GDX. I think we're coming in a little higher here on GDX. Yeah, up there around 34.10. I still think halfway back, I know I sound like a broken record, or 61.8 back could still happen. I also want to talk about how one day can change a trend. Okay. So, I traded this TLT rally pretty good. I gave this as a buy point, called the breakout, But then I had this 93 level that the market was trying to hold on a few occasions. And then Friday, with a pretty benign inflation number, they really cracked the bonds. I don't know if it's because of what's happening in France, because their yields are going up. The explanation that I heard was, well, you know, Trump trounced Biden in the debate, so it's a foregone conclusion that he's going to be the next president. Guys like Summers are saying that um, another Trump presidency would be even more inflationary than we have now. So they got to the bonds. And I just want to show you, and we're going to open lower here, that you had really 2 months of good technical action, almost three, and how one day can change it. So am I buying the break here? No. Did I get short? No. So I've turned from being constructive to being neutral. Are we going to pull back and regroup? It's possible. Or we could have an accident waiting to happen if I look at the weekly, and that would be that this was really a pretty short-lived bear market rally, did nothing great, and that we're going to see rates spike again and maybe set up the third drive to the bottom. But right now, it tells me, I'm not buying them here. And it's the same with the 10-year note. I know one thing about the 10-year note, that under 420, rates are going to fall precipitously. But Friday changed the whole picture there too. We're on our way towards heading towards that breakdown here. And then we had the benign inflation report, and the market turned up aggressively and following through 5 bips higher now. So I might have a bias long term, but this isn't the kind of action that I'm willing to stake money on my bias, and I'm neutral now. So we'll see what happens. I have to let this play out. All the while, with the knowledge in the back of my mind or on my charts, which is better than the back of my mind, that back under 420, we're going to have a big drop in rates. But when will it? Will it even do that? Could we break out here? Could we get a retest of these levels and have some type of correction to shake out the bulls in the notes and in the bonds, which is already happening? Possible. But this day, like I showed you in TLT, changed my mind once we started closing back under 93. I'm not buying this break yet. So I also want to talk about S&Ps and NASDAQ because I did mention that I think a correction is imminent. Are we going to probe one more high in S&Ps before we head lower? Sure, anything can happen, but I still believe that we're primed for some type of correction. I have two drives. We had pretty good divergence there. NASDAQ was even weaker or acting weaker. And what's interesting is with NASDAQ down, and I mentioned this Friday, Russell is up. Okay, so probably can't get real bearish a whole market if Russell's going to finally come out of the hole. But I talked about a pair trade being short the Qs and long the Russell, which it's been the opposite for a long time. And here's the reasons why I think that the Qs are ripe for a correction. So I went through some of the leadership in the Qs, and we all know that last week, before it was happening, and before we confirmed it that day, I was on with Mike and said, we have a potential key reversal in semis. And we did. And semis didn't bounce much. It looks like a bear flag to me, and there's lower levels left. Also called the key reversal while it was happening in NVIDIA. And NVIDIA is coming in lower again. Could we get some type of rally back to 130? But this too looks vulnerable. So now let's talk about this mega cap tech that kept rallying. Even after NVIDIA peaked and the market made an attempt at new highs. So here's Amazon. I know I was waiting for a rally back towards 191 to get short, but this candle dissuaded me of it. But it's still, now I have a new contingency. If we start closing back under 191, you have a false breakout. And we did not make new RSI highs. So there's Amazon diverging. Here's Meta. Okay, Meta, while the Qs were making new highs, still hasn't taken out its April highs. It's not something that I'd be long. It looks ripe for a correction. Okay, here's Google. Look at the RSI at new highs. It's up a little bit today. Maybe it makes another new high, but that's not the kind of chart formation that I get long. It's been diverging, and these are momentum stocks. So if it's a momentum stock, it's been steadily losing momentum since the end of January without being able to take out this RSI high all this time. I wouldn't buy Google. Here's Netflix. Okay, Netflix, um, another one that's been diverging since the end of January. Getting some divergences here, maybe a little over 80. That's not a chart that I'd be long. I might be looking to buy a break, $50 lower, but I'm not long from up here. So I'm not saying crash. I'm saying ripe for correction. Here's the last one I'm going to show is Microsoft. Microsoft diverged at new highs. Can it try and make another high? Sure, it could, but it won't confirm this time. So momentum is tired on these mega cap tech, and the rotation may be out of these, just like we had Goldman Sachs reported a record amount of selling in tech stocks during the month of June. Not just a lot of selling, key word, record amount. Anytime something sets a record, I pay attention to it. So I'm not the only one. These guys that are handling billions of dollars were liquidating pretty aggressively in the tech stocks. And maybe they think they're a little rich and they could come in and then redeploy. So that's what I wanted to talk about in the market. Is the S&P going to fall apart? I don't think so. But we could have something like a pullback into sometime this month, maybe back to 5,300, back to these old highs, and then make another attempt to rally and head towards 6,000, where a lot of the bulls are targeting. A lot of the people that I know whose work I respect, they're talking about this rally being finished late August, early September. So there's still a couple of months of runway left for the market to peak. I think in the interim, there's going to be a pretty good correction in stocks. So I hope that this, you guys may want to play this again, especially get the part about that the market doesn't care where you liquidated your position, and just forget about it and go with what the market is saying today. Today, the euro said we're gapping up. Maybe there are more shorts to squeeze, and people are looking for a real negative reaction. Doesn't mean they can't get it next week. I've heard that if there is a hung parliament in France, that people are looking for the euro to get cracked. We also have an election Thursday in the UK. So watch that. The last thing that I'll show you is check out Euro Pound. It's right back to major resistance, which used to be major support at 85. If you want to try this, you could be short here, risking closes back over 85. Intraday stop, maybe you risk 50. So Mike will be with you later on. I'll be back with Mike tomorrow. Good hunting. Be careful. There are a lot of people on vacation for the whole week, so volume's going to be thinner than usual. And remember that even though volume's thinner, it's not going to stop the data points from coming in all week. So I'll see you in the room. I posted what I talked about today in the room last night to give people kind of a heads up into the week ahead. And remember, most of all, don't just count your pips, count your blessings. See you in the room.